Hey guys, what's going on? It's your big dreamer and doer, G Dinero, coming to you today with a Money Monday. Today we're going to talk about, can you retire on stretch, or STRC, one of the preferred products that comes in from MicroStrategy. But first, remember, none of this is tax, financial, legal, investment advice. It's your buddy G Dinero helping you increase your financial literacy to help put you and your family on that path to financial freedom. So let's dig right in. Money. So here's where the inspiration came from. Last week, Strategy announced that they currently offer a 10.25% annual dividend rate. Actually, I think that was a little over 1 week ago. Let's see, today's the 21st, 20th. Yeah, last week. Paid monthly, right? So it's a dividend that's paid monthly, and the Strategy put out and said, stretch your income. And so then I just threw this out on X. I said, okay, what if you took $1 million, bought 1,101 shares of STRC, you collect the 85.4 cents per share dividend per month, reinvested in more shares through DRIP, which I will explain later. Do this for 10 years. And congrats, you're now holding $2.8 million worth of STRC, yielding $24,000 a month. Thank me later. So it's later. And now I'm going to tell you why you're going to thank me. So what is STRC? Stretch. Stretch is a perpetual preferred stock that accrues cumulative dividends at a variable rate per annum on the stated amount of $100 per share, payable monthly. Okay, so it's a preferred share issued by Strategy, backed by Bitcoin, collateralized by Bitcoin, that pays the stated amount, the variable interest rate per month, and currently that's now 10.25. It initially launched at 9% per annum. It's been raised to 10 and now to 10 and a quarter. The whole point is to keep STRC trading in a range between $99 and $100, with 100 being the par value. That's the value that it's designed to trade at. Sometimes a little below par value, sometimes a little above, but it's designed to trade right at and around $100 a share. So the simple math is, if you take 10.25%, the current annual interest rate, divided by 12 months, that equals 85.4 cents per share per month that you would earn on your STRC. Whole lot better than what you're getting in a money market account or a CD or your savings account, and especially savings account at all the four major banks here in the United States. Or if you live over in Europe, parts of Europe have negative interest rates. They charge you to hold your money in the bank, which totally doesn't make any sense to me, but supposedly they're doing that over there, or they were. So how safe is STRC? Well, STRC is a short duration, high yield credit, right? So it's for people that are seeking stable value with a higher yield than money markets. And you guys may have seen this slide. I've used it in other videos where I talked about when they first launched Stretch. I'll maybe link to one of those videos over here so that you can go back and take a look at it. But bottom line is, it's a monthly variable cash dividend with an effective yield of 10% per annum. That was at the IPO. It's now at 10.25. It's designed to enable price stability near 100. Via variable dividend, call option, and ATM. Any monthly step downs are capped at 25 basis points plus the maximum decline, if any, in a 1 month SOFR from the first to any business. Blah, blah, blah. It's variable. So they could pay less than 10.25% per month. They could pay less than 10. But chances are it's trading then above par value. So they're doing that on purpose to try to pull the par value price back down below 100 again, or at or below 100. Biggest IPO basically of the entire year was STRC at $2.521 billion. They did file a $4.2 billion at the money program, not to be used below the $99 STRC share price. So when you see the share price creep up over $99 a share, yes, they will sell shares of STRC into the open market and use that money to go buy more Bitcoin, which accrues to the common shareholder, the MicroStrategy common shareholder, and gives them more sats per share without diluting their equity share. Those are the MicroStrategy common stockholders. Targets short duration investors seeking a stable value with a higher yield than money markets. So the effective yield as of July 30th, 2025 was 9.5%. It's actually currently at about 10.4%. That's because it's trading below par value. It's trading at 98.50. So you have to take 10.25% divided by 98.50, and you come up with like 10.4, 10.5% is what its current effective yield is. And it has a Bitcoin rating of 6.1x. That was as of July 29th, 2025. I think it's currently, Bitcoin rating is currently around a 5.7, 5.8x. So still very, very high. So is it taxable? That comes up all the time. I am not a CPA. I'm not going to play one on television today. I'm here to help you think about this and go have that discussion with your CPA. But per the IRS Form 8937 that they filed, which is a report of organizational actions affecting the basis of securities, the stretch or STRC, quote, distribution will be a non-taxable return of capital to the extent of a preferred shareholder's tax basis in each share of STRC shares. So if indeed it is a return of capital, for many of us in the United States, that is not a taxable offense. You can't get taxed on that. So it could actually be a way, because it's designed as a return of capital, until they've returned the entire amount of capital that you've put in, which would take 10 years, right? 10% times 10 years is 100%. So for 10 years, it could theoretically be just them returning your capital back to you. So you're really not earning any interest, but instead a return of capital. Again, beyond that, don't start drilling me with questions on it, guys. I am not a tax expert, okay? I just play one on TV, and I'm not playing one on TV today. So how safe is it? Well, let's take a look. This was their slides from their investor deck. Again, this was back at the end of July, early August when they when they did their last investor call. But debt and preferred equity is 39. So 39% of their $8.2 billion in convertible debt is in the money, right? So 39% of it is in the money. If you look, the total debt maturity on average is out over 4.7 years. You can see that on the convertible debt, the pink line, and about $8.2 billion in notional value, or $12 billion in market value, because some of those 39% are in the money. So they would convert and instantly be in the money. They make money on them, just like an in the money call option, for instance. As far as the preferred equity is concerned, what you notice there is $6 billion worth. There was $6 billion worth that had been issued as of that time frame, and that's based on an at-the-money conversion. Those are all perpetual. They have no maturity. They don't have to be paid out on a specific date. They just have to continue making dividend payments on 3 out of 4, and one of them is non-cumulative. They don't have to on the STRD, but they have been paying it out on a regular basis. This is what it looks like, the actual dividends. At the time, it was $614 million in annual dividend and interest expenses. So they essentially had enough money to pay out for over 100 years. If you just took the value of the Bitcoin on the balance sheet, if they never raised another cent, if Bitcoin never went up another $1, they could pay out their dividends or these return of capital for the next 100, I think it was in 24 years. When you look at the converts, the interest on the debt is $8.2 billion per year, or an annual interest expense or dividend of $35 million on the interest on the debt, right? Because the coupon's at such a low rate. If you look at the cumulative dividends, again, 3 out of the 4 are cumulative: STRF, STRC, STRK. When you look at that, that totaled about $460 million that they needed to pay out in cumulative dividends on an annual basis, and then $120 million a year on STRD of non-cumulative, for a grand total of $614 million in annual dividend expenses and interest on the convertible bonds as well. So here's the coverage that we're talking about. So When Bitcoin was at $118,000 per Bitcoin, that was when the slide was made back in July. Right now, we're lower than that. I think today we're somewhere around 108, let's say, at the time I'm making this. Bitcoin's debt coverage, they had $74 billion worth of Bitcoin holdings at the time. They had $5 billion worth of existing out of the money convertibles. So those were not in the money, basically. No other way of saying that. So their Bitcoin coverage was $69 billion. So that's $74 billion of Bitcoin and $5 billion worth of out of the money converts. That's a 15x coverage in that particular case. Said a little bit differently, their dividend coverage. So that again is for the convertible debt. This is for the dividends. The dividends are the preferred stocks. You notice they had $74 billion worth of Bitcoin. They had $5 billion worth of out of the money convertibles. That's $69 billion worth of Bitcoin coverage. The annual preferreds is $580 million a year, or 0.58 billion, $580 million a year. And they have 120 years. That's where I was getting that number from. About 120 years worth of preferred dividends, or about 18 years worth of preferred dividends, even if Bitcoin declined by 75%. I hope you understand how important that part is. So if Bitcoin declined from roughly $120,000 and dropped all the way down to $30,000, that's a 75% drop. It lost 75% of its value. Then the amount of Bitcoin would still be enough to pay out preferred dividends for the next 18 years. 18 years. I don't know about you, but I don't think Bitcoin's going to drop by 75% and stay down there below at a 75% decline, stay down there at $30,000 for the next 18 years. I don't see that happening. So that's when we're talking about how over collateralized it is. Now, I don't want to say it's without risk. Of course, there's always a risk that Bitcoin could go to zero, but you got to ask yourself, what are other things collateralized by? They're collateralized by things like US Treasuries. They're collateralized by things like other types of cash instruments, but fiat cash is also devaluing at 10% per year, 14% per year. I've heard that high from Safety and Amos and Invest Answers, right? So it depends on what you believe in more. Who do you think is going to be more likely to pay you back at the end of this thing if something were to go terribly awry? Do you think that the government's going to stop printing money and all of a sudden your dollar is going to gain in value over the next 5, 10, 15, 20, 30 years? Or do you think instead that they'll continue printing money like absolute crazy, like they have been? Money printer go, brrr, right? One of those. And instead, Bitcoin goes to the moon over the next 5, 10, 15, 20, 30 years. And thus, they always have the ability to repay you at any given time in fiat if you wanted to make sure that you got your money back out of the dividends and then ultimately the shares of preferred stock. So I hope that part makes sense. This is the part that trips a lot of people up. They think it's incredibly dangerous. I'd much rather have Bitcoin backing my fixed income product than US Treasuries, because I know the Treasuries are going to be worth less in the future versus the Bitcoin that's going to be worth more in the future, because they're just going to keep printing money into oblivion. So going back to my original post, let's do the maths. So today, at the time I made this slide, it's constantly changing, but at the time I made this slide, $1 million would buy you 10,152 shares of STRC at $98.50 a share. The dividend on that would be $8,670, which is 10,152 shares times 0.854 per share. You'd need to be holding STRC by the 15th of November, 2025, and the next dividend will pay out at the end of the month on 11/30/2025. Now you're like, well, wait a minute. Isn't there going to be a dividend payout at the end of October? Yes, you had to already have been holding the STRC by, really, you need to be holding it at the end of the day on the 14th. It says the ex-div date is the 15th, but you have to already have it in your account. You can't buy it on the 15th. It won't count towards this month. It would count in towards next month. Okay, so that's what they mean by ex-div date and dividend date. Ex-div is when you have to be holding it by. Dividend date, when it gets paid out. This last one was the 15th of October, was the ex-div date. Payout was on the 31st. Happy Halloween. It's going to be a treat and not a trick. You can either A, live on that said dividend, right? Maybe you want to just live on $88,670 a month, or B, reinvest it every month, buying more shares of STRC with a DRIP. What does that stand for? Dividend Reinvestment Program. So let's say you DRIP, drip it back in, and you do this for 10 years. What would the results be? This is it on a graphical form. Yes, this is a spreadsheet that I made, that your 10,152 shares, if the yield stayed at 10.25%, which it won't, it'll go up, it'll go down, but I just left it as a fixed 10.25%. How many, you're not going to invest any more money in, right? All you're doing is reinvesting the shares. So the first month you have about, it looks like 88 extra shares from the dividend reinvestment program. The next month, 80, 89. Anyway, I know you can't read the chart, so here you go. The first month you'd make $8,670, which reinvested at approximately $99 a share would gain you an extra 88 additional shares. Okay, well, what if it's $100 a share? Okay, then you're only going to get 87 additional shares. What if it's at 98? You might get 89 additional shares. Don't get hung up on 1% up or down on the share price, whether it's $99, 100, 101, 98. Don't get hung up on that. Look at the big compounding effect of time in this situation. So I went on the low end of the range that they give and said it's at $99 a share. You got an extra 88 shares. Now you have 10,152 plus 88 additional shares. You now have 10,240 shares, which generate $8,745 next month, which gets you 88 more shares, which is now 10,328 shares. You get the point. It just keeps doing this and starts to grow exponentially the longer out you go. Ultimately, you end up with 28,540 shares of STRC in 10 years, worth approximately $2.85 million. And those shares are generating $24,000 a month in income, which is easy. You take 28,540, multiply that by 0.854. Remember, 85.4 cents per share. And that's where I came up with the $24,000 a month in income, all collateralized by Bitcoin and engineered by an MIT engineering graduate by the name of Michael Saylor over there at STRC, which is brought to you by Strategy or MicroStrategy. I still call it MicroStrategy, even though the name of the company is now Strategy. Guys, I hope you found value in this today. If you did, smash that like button. Drop a comment below. What did you like best? What did you learn? What would you like to see more of? Make sure you're subscribed to the channel so you don't miss any of these videos that I'm putting out. And finally, book a course or join the community over at gdinerocoaching.com. The community is launching insanely soon. I promise, guys. I just got to make a couple fine-tuning things on my end. And it's going to be exciting. But in the meantime, you could go over there and take my TradingView and Technical Analysis course, where I teach you everything about TradingView and Technical Analysis, including the paid invest answers indicators, if that's something you're interested in learning more about. And I have my Understanding Options course, where I teach you everything from the terminology and the Greeks all the way up through doing more complex trades like synthetic longs and bull call spreads with covered calls and selling puts and the wheel strategy and everything else thrown in between. Guys, I'm G Dinero. I'm here to help you increase your financial literacy, to help put you and your family on that path to financial freedom. Thanks for tuning in today, and we'll see you next time. Take care.